pleased to say joining Matt and me this morning is Ilana Weinstein, CEO of the IDW Group, a top executive search firm for the hedge fund industry. Ilana, thank you so much for joining us, this industry. And of course, we can say, obviously, Goldman Sachs business is not a hedge fund. But if there are advancements being made
Did he just say talent slowdown?
Yes, was talent, that? Exactly.
Okay.
And I just wonder if a bank can find efficiencies and if they can find ways to make workers more productive. Can hedge funds do the same too? Are technologies allowing them also to slow down on their acquisition of talent?
So that's a really interesting intro to this segment, because for all of the headlines of hedge funds have had a banner year, they've put up great performance, which we can dig into because I think these averages obfuscate what's actually going on. The real headline for hedge funds is not inflows and capital. We have $5 trillion of AUM. This industry has a tremendous amount of capital. It doesn't have a capital problem. It has a talent problem. That's the problem. All of these funds, and by the way, when I say all of these funds, the majority of inflows since 2022 have gone to the multi-managers, which are the most voracious acquisitors of talent. When you talk about efficiencies, yes, you can make certain aspects of the fund more efficient, but you can't, there's no replacing the talent that is deploying the capital. And these are paradigms with multiple PMs, multiple teams. And the reason some of them are actually giving back capital or being really discriminate about how much they take in is because there has never been a bigger supply-demand imbalance with respect to talent. The talent war is as intense as it's ever been. So it kind of makes me laugh a little bit to see the other side of the equation, which is like we're having a slowdown with respect to talent growth. By
the way, you have arguably the deepest look at hedge fund performance because you're seeing it on an individual manager basis, but also across funds. The headlines that we've been reporting about 2025 have been really phenomenal. Best returns in 16 years, gathering the most in terms of inflows since 2007. Is it not?
Right.
Are we wrong to paint hedge funds with such a broad brush?
I think it's almost kind of like, you know, the average car in America went up by X percent. Like, what is it actually telling you in terms of the price? What we do, we're like surgeons, Matt. We go in and we do the same thing LPs are doing, and we ask the same questions, which is how much of the performance is alpha net of fees relative to the underlying beta. We're looking at performance relative to the volatility employed. We're looking over a 3-year and a 5-year basis. One banner year, you know, does not an industry or a fund make. And at the end of the day, when you look at all of this, and let's not forget too, a whole segment of the industry had a huge tailwind. That's the long short world, right? We had a stock market boom. Kind of everything worked this year. Right. All the, you know, the stage was set for funds across all strategies to have a good year. Like, this is, I would say the differentiation is if you didn't, shame on you. There are very few funds that are that exceptional. They're out there, but they're few and far between. And that is why you see so few funds hoovering up the capital in this industry. 10 years ago, and I bet you the percentage hasn't changed much, 10% of funds controlled 90% of AUM. Now, some funds have gone out of business, some are closed, maybe the percentage is slightly better, but thematically it remains the same. There are very few funds that really are giving LPs value for the fees that they're paying.
Without those details, if you were to just look at the headline level, another conclusion you would have made is, wow, this must be a great time to launch a fund. Everybody's doing well, there's lots of demand. But given what you're saying, that there is wide dispersion, yes, we had a few big splashy launches like Bobby Jane's fund. Is it a good time to be starting your own fund?
Okay, so there are two ways I can answer that question. Let me start with the Bobby Jane comment. You guys did an article a couple of weeks ago about the fact that the gross return of that fund was mid-teens and the net return was a quarter of that. So I think I'll get to your question on launches, but there's an important point here, which is you want to be really thoughtful if you do launch at the scale with which you launch, especially a multi-manager. because you have to deploy all of that capital and you have to hire multiple PMs to do it, and they have a lag with respect to showing up, right? They have non-competes, the team has non-competes, you're also spending on R&D, on technology, on ops, and so it takes a while for the machine to prove it's working. That's on scale. On launches, you're right, there have been very few single manager launches of note that are north of $1 billion. There is NX1, Harvey Capital, Aventir. That's really off the cuff, what I can think of as the notable launches. Every single one of those was started not just by a senior investment professional, but somebody who was co-PM or co-CIO managing the fund. So there's a footprint there, which is very unusual, and I think LPs were able to get behind that. But otherwise, it's really tough, which is why you're seeing the number of SMAs that we're seeing with respect to new funds starting. And this goes back to the talent issue. If it's hard for multi-managers to access talent to keep pace with the amount of capital that they have to deploy, Millennium being probably the most extreme example of that at $84 billion, and also the most prolific allocator to new launches in 2024, they gave more money to the industry. Remember, they're a hedge fund themselves. They're allocating externally than those that are supposed to allocate, than institutional LPs. And this past year, they were behind 4 of the 9 biggest launches. But those situations often come with strings attached, right? It's the only LP for a period of time. It's 3 years before you can take in other capital. There's transparency that potentially the allocator has into your book, which if it's a hedge fund could be a problem.
Ilana, can I just ask quickly, what does this mean for managers that want to move right now? Or if I look at Marathon, and I know they're not a hedge fund, they're an asset management company, but if they want to leave some of those women and men, is it a good market for that?
I mean, if they're talented, absolutely. You know, like we're all over talent every day of the week, and there's a knife fight for anyone who's talented. So is there there a good market for talent? That's what I mean by supply-demand imbalance. Talent is holding all the cards. And the challenge for top hedge funds is to figure out how they're going to differentiate themselves so that, and I say top hedge funds because if you're a second-tier fund, you don't have a prayer of attracting the best people out there because they have incredible options. The challenge is figuring out how you're going to differentiate yourself. A check is not enough. Like back to those SMAs, just writing somebody a check, we have a while before those SMAs prove themselves out. This is a relatively new phenomenon born of the incredible growth that the multi-managers had over the last, let's call it 3 years. Yep. We'll see how well those funds do. But then you look at a fund like ILEX, right? That is an example of a hedge fund, Woodline, giving a strategic investment to a startup, but doing a lot more than just writing a check.